In the previous video, we talked about how wars don't just shape borders, they shape markets. But there's something even more unusual happening beneath the surface. Because in the modern global economy, conflict doesn't just disrupt systems. In many ways, it's built into them. Entire industries expand when instability rises, markets react, budgets grow, and money begins moving through predictable channels. Not because anyone secretly planned it, but because the system rewards it. And once you start looking at war through incentives instead of headlines, you begin to notice something unsettling. Modern conflict isn't just geopolitical, and whether you realize it or not, you're already part of that system. To understand how this works, we need to start with one simple concept: incentives. An incentive is simply what a system rewards. Every large system runs on them. In business, the system rewards profit. In politics, it rewards funding and re-election. In media, it rewards attention. And in financial markets, the system rewards predictable revenue. So when something consistently produces revenue, funding, or engagement, systems naturally reorganize around it, not through coordination, but through repetition. And conflict produces very specific patterns. Defense budgets expand, security contracts multiply, energy prices shift, media attention intensifies, entire industries grow during periods of instability. Over time, those patterns become familiar. And once a pattern repeats often enough, it stops looking temporary. It becomes structural. But war wasn't always structured this way. Before World War II, most countries did not maintain massive, permanent defense industries during peacetime. Military production surged during wars and then largely scaled down afterward. But World War II changed the scale of everything. Factories were converted into military production lines. Industrial output exploded. Entire sectors of the economy were reorganized around wartime production. When the war ended, something unexpected happened. The infrastructure didn't disappear. Research continued, production capacity remained, defense contracts continued flowing. What had once been temporary wartime expansion slowly stabilized into something permanent. In 1961, President Dwight Eisenhower warned about this transformation. He called it the military-industrial complex. He wasn't describing a conspiracy, he was describing a structure. A permanent relationship between the military, private contractors, and government funding. And once that structure existed, every new conflict reinforced it. Budgets expanded, technologies advanced, industries grew. Over time, war stopped being only a geopolitical event. It became an economic sector. Today, global military spending exceeds $2.4 trillion each year. The United States alone spends more than $800 billion annually on defense. That's larger than the entire economies of many countries, and this isn't emergency spending, it's institutional, budgeted years in advance, planned across long-term government cycles. That money flows into contracts, those contracts flow into companies, and many of those companies are publicly traded, which means investors own them, which means retirement funds own them, which means large index funds, the same ones many people rely on for long-term investing, often include defense exposure. So when defense budgets expand, revenue visibility increases. And when revenue visibility increases, markets respond. At that point, conflict stops being just a political event. It becomes something markets can model, something investors can price, something analysts can forecast. War becomes a variable inside financial systems. But most people don't experience this through stock markets. They experience it somewhere much closer. Energy. Conflict often disrupts oil markets. And when instability threatens supply chains, oil prices tend to rise. When oil rises, transportation costs increase. When transportation becomes more expensive, the cost of moving food and goods increases. That's inflation. And when inflation rises, central banks respond. Interest rates increase. Higher interest rates ripple through the entire economy. Mortgage payments rise. Car loans become more expensive. Businesses face higher borrowing costs. Credit card debt becomes heavier. This is what economists call a second-order effect. You may never invest in a defense contractor, but you still experience conflict through gas prices, groceries, housing costs. The financialization of war isn't always visible, but its ripple effects travel everywhere. There's another layer quietly shaping how we experience conflict. Information. Conflict drives attention. Attention drives engagement, and engagement drives revenue. Urgent headlines outperform calm analysis. Fear spreads faster than stability. This doesn't mean coverage is fabricated. It means intensity captures attention more effectively. And attention has economic value, so coverage expands because it works. War becomes content, and content becomes monetized. At the same time, large financial institutions respond to instability very quickly. When geopolitical risk increases, major funds reposition capital. They hedge exposure, they rebalance sectors, they adjust allocations, and they often do this quietly and early by the time non-stop headlines reach most people. Professional positioning has already begun. Retail investors and everyday individuals often react later, and reacting emotionally during volatile markets can increase risk significantly because markets tend to move faster than narratives. You can't control geopolitical events, but you can control how vulnerable your life is to financial shock. That starts with asking a different question. Instead of asking, how do I profit from global conflict? A more useful question is, how resilient am I if global costs suddenly rise? Because resilience is what protects you from ripple effects. Don't let headlines control financial decisions. Markets have historically recovered from many geopolitical shocks. Emotional reactions often lock in losses. Long-term discipline tends to outperform short-term panic. Focus on what actually affects you: energy prices, inflation, interest rates, job stability. These factors influence daily life far more than geopolitical speculation. Understanding them gives you far more control. Build structural stability. During global instability, three fundamentals matter more than ever: emergency savings and diversified income streams. None of these are dramatic, but they reduce vulnerability to economic shocks. Protect your attention. Constant exposure to crisis increases stress. Stress reduces clarity, and clarity improves decisions. The attention economy monetizes urgency, but you don't need to consume urgency constantly. Your psychological stability matters just as much as your financial stability. War is tragic, but in modern systems, it is also institutional, budgeted, contracted, modeled, integrated into markets. Understanding this doesn't mean endorsing it. It simply means you're less likely to be surprised by it. You cannot control global conflict, but you can control your liquidity, your debt exposure, your diversification, your emotional reactions, and the information you consume. Because when conflict becomes embedded in economic systems, stability becomes a personal strategy. And in uncertain systems, the most valuable asset isn't speculation, it's resilience. If this video helped you see global events a little differently, that's exactly what this channel is about. We break down the systems shaping the modern world, the economics, the incentives, and the structures most people never see. So if you're interested in understanding how power, money, and global events actually connect, consider subscribing, because the deeper you look into these systems, the more the world starts to make sense.